What we're seeing now is a shift away from sectors to more asset specific, submarket specific. And that really changes the landscape and the need for investors and lenders and tenants to really understand the specific building, the specific submarket. And we felt like that was something that we wanted to highlight as one of the major trends in this year's publication.
Hello and welcome to the REIT Report. I'm your host, Sarah Borson-Keto. My guest today is Andrew Alperstein, real estate partner at PwC. Andrew is with me to share some of the key findings of the Emerging Trends in Real Estate Outlook for 2026, produced by PwC and the Urban Land Institute. Andrew, good to speak with you again.
Likewise, good to be here.
Andrew, how would you describe the mood within the commercial real estate industry as we now look to 2026? And can you compare what you're currently seeing regarding sentiment and investor behavior versus the previous few years?
Sure. Part of what we do as part of developing the publication is we survey well over 1,000 folks. We also do 500 plus interviews. And so that gives us a good feel, both in a quantitative and qualitative way, around where sentiment is. You will have probably noticed the theme of the publication is navigating the fog. And it really is a reflection of the uncertainty that exists for folks in the industry, whether it be interest rates, whether it be transaction activity and valuations, whether it be the various policy aspects that we're dealing with, tariffs and immigration and taxes and the like. And that has put a little bit of a dampener on sentiment as we look to 2026 relative to 2025. If you recall, coming into this publication a year ago, we had seen a nice uptick in sentiment as we finished 2024 and headed into 2025. Some of that was we were getting through the presidential election. There was an expectation of lower interest rates. Unfortunately, that 2025 didn't probably materialize the way that folks hoped. And I think that has dragged on through the year and is reflective of that kind of slightly muted sentiment. A lot of the conversations we had, Sarah, we talked about are people glass half full versus glass half empty. And a lot of folks are kind of on the fence a little bit and want to be optimistic, but cautious because of the level and nature of the uncertainty that exists. So it was tough from a sentiment perspective, because I think we were hoping for another year of kind of improvement. And unfortunately, it tapered off just a little bit.
And are there certain areas of focus or strategies that you see as central to accessing whatever opportunities there are in commercial real estate in the coming year?
It was interesting, and you'll see this in the publication. We went through a cycle, particularly coming out of COVID, where sectors were a big focus. So industrial was a big focus. Multifamily was a big focus. What we're seeing now is a shift away from sectors to more asset specific, submarket specific. And that really changes the landscape and the need for investors and lenders and tenants to really understand the specific building, the specific submarket. And we felt like that was something that we wanted to highlight as one of the major trends in this year's publication.
It sounds like it's a lot more labor intensive if you have to drill down into assets.
No question, Sarah. I mean, part of what we'd seen with cap rates coming down and very low interest rates, we'd seen a lot of value creation through financing and through lower cap rates. What we expect is that a lot more value creation will need to come through property operations, really driving revenue growth or rental growth, really being focused on expenses and capital spend, and less so on the capital markets in the coming years. Absolutely, it's going to take more work. We do talk a lot about AI and the impact of AI on operations and how that might help, but I think we've got a ways to go.
And geographically, what are among the most dynamic or interesting markets for commercial real estate today? And are there particular attributes that these locations share?
So we highlighted a couple different trends in this publication, and I'll maybe run through a couple of those. So number one is, if you look at the top 10 markets to watch in 2026, you'll see that there's 4 markets in the Northeast. That's the most we've seen in a number of years: Manhattan, Jersey City, Brooklyn, Northern New Jersey. And that's really a reflection of how Manhattan and New York has bounced back in terms of return to office. We've seen a lot more young folks moving back to the city and wanting to be in the office and enjoying everything that New York has to offer. So we thought that was an interesting bounce back story. I think secondly, we continue to see the Sun Belt performing very well. There are markets in the Sun Belt that were overbuilt, and there's going to both on the multifamily side as well as industrial that we'll need to work through. But if you look at markets like Dallas, which was number one in the publication, Miami, that was number three, they're the beneficiaries of a lot of migration, a lot of companies moving to those markets. They're business friendly, lower taxes, have access points, whether it's ports or airports. So those were two kind of more macro trends. The other important trend that we highlighted was how some of the CBDs have started to show some green shoots. I talked about New York City particularly, but San Francisco has seen some improvement as some of the tech and AI companies start to take more space, and as the city starts to clean up some of the security and safety concerns that we had a couple of years ago. So I think there's some interesting aspects to watch from a geographic perspective. And when you layer in the uncertainty around immigration policy and how immigration has really fueled not just US population growth, but population growth in a number of particularly Sunbelt markets in Texas and Florida particularly, there's a lot to keep an eye on from a geographic perspective, just given some of this kind of unprecedented policy change.
And turning to specific sectors, the data center buzz continues apace, but would you say that 15% growth in annual asking rents is sustainable?
It's a really good and important question. I think what we heard loud and clear is more and more market participants are either in the sector or looking to get into the sector, whether that's debt or equity. There's also a cohort of folks that say this is operationally intensive, takes a different kind of experience, has a whole different time span and size of deal, and they're sitting out. For the folks that are in it, a lot of the focus has been on new development for the hyperscalers, and we've seen a lot of success in terms of getting those built, leased up, and starting to stabilize. What's going to be really interesting to your point is, number one, as some of these really sizable properties start to stabilize and folks look to either sell or recapitalize or refinance, it will be interesting to observe who are the players that want to play in the stabilized data center business. These are long-term leases. They typically have fixed escalations. You have typically strong credit, which is offset by these are very large transactions. We do have a different kind of obsolescence consideration than we've had in any other property type. And the pace of change in technology is just hard to underwrite. So we're going to have a really interesting 2026 because some of these transactions will occur and we'll start to get some indications of who the players are, how things are going to get priced, how they're going to get financed. So that's one piece of it. Your question around rent growth is going to be fascinating to watch because supply is limited primarily by power. And we've seen lots of headlines about developers' inability to secure power. And that is the biggest kind of slowdown from the supply side. I think on the demand side, if you go through a lot of particularly the hyperscalers' earnings reports and things like that, the expectation is they continue to invest. They continue to need space, whether they buy or lease. I don't know if 15% is the magic number, but it's certainly going to be very positive because the supply side at least appears to be limited for the foreseeable future because of the power limitations.
Power is the big unknown, really, going forward.
Yeah, exactly.
And turning to the senior living space, which is another active sector, do you see a broader range of offerings catering to older adults who are looking for alternatives to traditional elder care facilities?
No question. We actually highlighted senior housing a year ago in the publication, and most of the focus there was on the middle market and how if you look at where supply exists in the US, the high end of the market, there's quite a good amount of inventory and supply. The low end of the market typically tends to be government subsidized, and so there is supply on that side, but we've got this huge middle market, and this applies to multifamily too, a huge middle market that is not being planned for. And if you look at some of the metrics that we highlight in the publication, you'll see that the number of US citizens hitting, I forget if it's age 75 or 80, is going to continue to increase for the foreseeable future. The amount of senior housing supply has not increased commensurately. And so the fundamentals look really good. The details really matter here, to your point, which is where's that demand geographically, where's the price point, and will the supply match that? To this point, it hasn't. And going back to your question, we have seen the over 55 product as being more interesting because it's more akin to multifamily, whereas some of the higher skill and care levels are more complicated because there is more operational experience and staffing required. We wanted to highlight really the demographic story because it shows how compelling the fundamentals are. I would also tell you that in talking to folks that we interviewed, many of them are in the sector and looking to go deeper into the sector as investors and lenders. A lot of the COVID challenges that we experience, whether it be illness in the communities or whether it be staffing and the cost of staffing, a lot of that has resolved. And so I think we wanted to highlight just the optimism around the sector. I think there's a lot of questions, to your point, around what do the different subsectors look like within senior housing? Where should they be located? How should they be priced? Who's going to develop them? But the overall fundamentals look really good.
Can you talk about how demand in the self-storage space is reflecting the general lack of mobility in the housing market at large? And why are vacancy rates for storage condos so low?
So this was an interesting one for us. We hadn't really talked about self-storage much. And just to step back a second, one of our major trends was around how niche property types have become more institutional and more essential. So if you think about data centers, you think about student housing, senior housing we were just talking about, and self-storage, they've become much more integrated, both from an institutional perspective, but also just in our day-to-day. The self-storage story is interesting because it has become more institutionalized in recent years. Historically, it had been a lot of smaller owners and operators. A lot of that has started to get aggregated with more institutional owners. A lot of self-storage demand drives off people moving. And obviously with mortgage rates at higher levels than we've certainly seen for a number of years, there's been less movement. And that has certainly had an impact on the storage sector. At the same time, supply has slowed down. We had a lot of supply coming through in 21, 22, 23. That has slowed down. But folks are also looking from a kind of cost of living perspective. We're starting to see folks move from bigger properties to smaller properties to make sure that they can stay in the areas that they want. And as folks move to smaller footprints, they'll likely need more storage. You brought up the storage condos, which was a new concept that we wanted to highlight in the publication this year. And I hadn't heard much about it, to be fair. But as we dug into it and went through some of the interviews, particularly folks that are in the space, it's certainly become more common and gives folks, just like any other condo, a different ownership. And you could think about it as an extension of their home, whether it's for storage, whether it's to have a golf simulator or to have a TV watching room. We saw all these kind of use cases coming through, and the condo just gives a bit more certainty and different ownership structure to allow folks to do that. So this is another subsector that we felt was evolving and that we wanted to highlight as a component of what folks in the market are thinking and talking about.
Yeah, I definitely had to Google that image for a self-storage condo.
Exactly.
Great. And Andrew, we've seen a number of positive earnings reports from office REITs in recent weeks. Does it seem like office has finally turned the corner? And are you seeing growth concentrated in top-tier assets, or is it more broadly dispersed?
No, I think it's still very much in the top tier assets from our discussions and the surveys. We wanted to highlight, maybe for the first time since COVID, that we were starting to see some green shoots in particularly submarkets of Manhattan, parts of San Francisco, parts of Dallas. There are not many, but there are some new buildings that are getting leased at historically high rents. And the common theme is well located, well amenitized, tech enabled. And that's what expanding tenants want for their employees as they return to the office in a more meaningful way. What's going to be interesting to watch is as those buildings get leased up, and there's not many of them because office supply and construction has really slowed down. What does the trickle down look like to the A- building or the B+ building? And do we start to see a bit more momentum more broadly, not just the A+ building? So I don't think by any means we're out of the woods on office. There's a lot of inventory that's probably either needs to be converted or demolished. And that's going to take a long time because there's so much of it and every market has different considerations and every asset has considerations. But we did want to highlight, Sarah, the green shoots that we were seeing and hearing. And it ties back into the kind of bounce back in New York. And hopefully we'll see more of that in other CBDs. And it's definitely something we're going to be keeping an eye on.
Andrew, there's a lot to digest in this report, but any closing thoughts on what you're seeing?
We were really pleasantly, I wouldn't say surprised, we were pleased to see the bounce back in the debt markets, both in the availability of debt, the sources of debt, the spreads that folks were able to achieve. If we recall, if we look back 2 years, like the availability of debt was really a challenge. A lot of the banks were out of the market. CMBS was slow. Debt funds were there, but they were more expensive. The life insurance companies were slower. All of them seem to be back. And that is an important catalyst for hopefully transaction activity improving in 2026. And the industry needs that. We need a vibrant transaction flows. At the same time, as we started the conversation, the uncertainty overhanging the macro economy and even local economies is still pretty pronounced. And so I think folks have a lot in front of them. It's a challenging time to be in our sector. And we hope that we've brought just a little bit of certainly some of the key trends to the surface in our publication.
Andrew, thanks so much for joining me today.
Absolutely. Nice to see you, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.